Welcome to the Value Investor TV podcast. My name is Beko and my partner Hari.
Hello.
Welcome to our channel, everybody. Welcome to our podcast. This episode, we are going to talk about a company that was suggested to us by one of our listeners, Signet Jewelers. Hari, you mentioned to me about this company maybe a couple years ago.
Yep.
Because of the way they lay out their retail store and how innovative that was, or kind of a good model to look after when you're analyzing retail business. So I took a look at this business some time ago, and one of our listeners told us that we should check this out. So here we are in this episode. We are going to go into this company in detail. But first, let's hear from Hari, about the usual disclaimer and maybe some key items that we always touch on in the beginning.
Yeah, so this is the Value Investor TV podcast. We are a podcast that teaches you about the concepts behind value investing. We are not financial advisors. We don't know your specific financial situation, or so please consult with an advisor before making any decisions.
Great. And just so you guys know, as I mentioned earlier, this company came to our attention because one of our listeners wanted us to analyze it. So if you guys have a company that you want us to look at and get our take on, please feel free to send that over to us at info@valueinvestor.org. So email us at info@valueinvestor.org. And as we will do in this episode, and as we have done in several previous episodes, we are analyzing companies based on our checklist. So we go through a checklist of questions to analyze every company. And if you'd like to have a copy of that also, please send us an email at info@valueinvestor.org. Just one last thing before we actually get started. Slack channel. So if you guys want to get involved more intimately and ask us questions about, I don't know, day-to-day, what's happening in the market currently, or if you guys have questions specific to a specific company, you can do that by joining a Slack community, Slack channel. So you have direct access to both of us, Hari and myself, as well as the rest of the listener community, value investor community. So if you guys want to join that, also email us at info@valueinvestor.org, and we would be happy to send over an invitation.
Yeah, and just one thing to add to that is, we publish the podcast, a couple of times a week, but on Slack you can hear from us directly and get answers. And with the way that the market is right now, in the middle of March 2020, or close to the end of March 2020, things change very quickly, and you can hear what other people who are our listeners do. And I'm actually very proud of our listeners. They are, in many ways, follow us very closely, and the value investing principles, and they present their case in a reasoned manner. And it's very humbling to hear that they do that, because when you're learning to invest, a lot of people that I see kind of follow the trader mentality. That's kind of the natural mentality for people, but this is a reasoned, logical approach. That's what we are trying to teach you guys, and to see other people follow it and make good, investment decisions is always, very pleasing to us, because, Beko and I know how to do this, but, we're trying to teach, and it's always good to see, as a teacher, that people follow what you say. So please keep it coming, and, please message us on Slack with any questions that you have.
Excellent point. So let's get started with this checklist, shall we, Hari?
Yeah.
So right off the bat, the first question we always ask is, what does the company do? So let's start off with that.
Yeah, so Signet Jewelers is, in their own words, the world's largest retailer of diamond jewelry, and they operate in North America, 2,700 locations. So I'll preface this by saying this is from the 2019 annual report. As of today, March 23rd, they have not published the annual report for 2020. And the reason that we wanted to talk about this particular company is actually because of that the market conditions right now with Feds changing the interest rate and all of this stuff means that you're operating off of imperfect information. So what I'm trying to do is piece together a valuation without having a full 10K. And why would I want to do that? Well, I want to do that because sometimes market opportunities appear and you have to make decisions. And so incomplete decision making is what separates the great value investors from the good ones or even the mediocre ones. So with that aside, Signet Jewelers is they operate about 2,700 locations in North America under the brands Kay, Zales, Jared, James Allen, Piercing Pagoda, and those mostly operate out of mall-based locations. They also operate in Canada under the People's brand and Mappins, and internationally they operate in the UK, Republic of Ireland, and the Channel Islands under H. Samuel and Ernest Jones. So, the short of it is that they are a jeweler. They sell mostly diamond jewelry, but they also sell watches and other, precious stones and metals as well. And what was kind of interesting about this company is that, like many other retailers, they have been hit hard by the move from retail being in person to the e-commerce world. So in 2019, they started what they called the Path to Brilliance, which is their reorganization of the company based on geography instead of based on their brand names. So what I found interesting about that was they differentiated Kay, Zales, and Jared. And if you watch these, you've probably heard if you watch football on TV, American football, you see the every kiss begins with Kay. They have these classic, things that they've been rolled out for a long time. And they were targeting specific, people. Like Kay was targeted towards men who watch, who are buying jewelry for their girlfriends and things like that. So they've kind of just gone away from that altogether and said, this is the new strategy is geography based. We are trying to make the customer experience much better. That's part of their Paths to Brilliance thing. And then they've talked about the omni-channel presence. So for retail, in retail world now, omni-channel means they've added e-commerce as well as brick and mortar. So you can buy anywhere, whether you're in person or online. And then try and instill a culture of efficiency and agility. So being able to respond to the customer. So that's kind of just, a very, very brief overview of them, for what they're doing.
Yeah, it's interesting that every time we talk about a retailer, right? It was, he started off with Skechers, Canada Goose, and GameStop. We looked at Ulta as well. Every retailer right now is going through some sort of transformation, meaning they have to evolve into the 21st century where e-commerce is a major influence, is a major force in the retail industry. And so obviously diamond, jewelry, buying and selling jewelry is not an exception here. It sounds like they're under the same kind of pressure.
Right. And I think the interesting thing about them being in that space is that, just how large, they're considered the largest jeweler in the world, but they only own about 7% of the market share in the U.S. So that just kind of tells you how fragmented the jewelry market is, right? So anyway, we'll keep going through, but just kind of give you an idea of the scope of this business.
Mm-hmm. It is an interesting fact. So let's move on to the second question, which is, does the does the business have a competitive advantage? And we have a few categories that we like to touch on to categorize them. So the first off is brand. Does Signet have a brand competitive moat?
So I think if they do have any moat at all, there is a brand moat, but I wouldn't say it's a very strong one. And the reason I say that is when you buy jewelry, right, you have the option to go to shop around to look for whatever you're looking for, and you can basically walk in a mall and go from K Jewelers to the various other mall retailers, to a department store, to wherever. But then you can also go to these mom and pop shops. You can go to a lot of different places, and really it's an undifferentiated product. So, nobody says, I want a K diamond wedding band, right? Or a K, or a Zales brooch, right? They are not based on the brand, is not why you decide to purchase it. Right now, you compare that to Tiffany's, right? Tiffany's has a iconic box. It comes in a particular color, and people tend to pay more for the Tiffany's stuff because it's a much higher luxury brand, right? So Kay and Zales are trying to target more of a middle class kind of buyer. They still want to buy something nice, but there's a lot of competition in that space, and so Jared and Kay and Zales are not really, there will be certainly places that people will shop, but that's not the destination when they're going to buy, right? And that's part of their problem, right? Is that even though they have a fairly large presence across the United States, and at just about any mall that you go to, you will find one of their stores, that doesn't mean it's the destination that you're going to when you have to buy stuff.
Yeah, so on that, I do have a clarifying question. Since I haven't done any diamond shopping myself, I'm not really familiar with this industry, but do they actually carry their own diamond, or are they just a pure retailer that sells other companies' diamonds?
So they do,
and luxury items.
They do a combination of both. So they source the diamonds themselves, and they make certain designs that they may buy in bulk. So they may go to a particular jeweler and buy enough bulk from that, to make it, if it's worth their while. And they mention that in the annual report. So they may have a unique design that they may sell for a season or two, with a specific, kind of setup. Like you may have seen the chocolate diamonds that they had, the Levion chocolate diamonds. So there's things like that they do, where they may promote it and they may push it in a certain way, but they also sell kind of more standard cuts. Like there's the princess cut, and there's different types of cuts of diamonds that you would get anywhere, right? And you can get those in, and it basically comes down to the commodity is, what is the size of and the weight and the clarity and all these other things that essentially sets the price for a diamond. So they have a little bit of scale that allows them to buy stuff, but for the most part, they're buying a commodity, they're selling a commodity, and they don't really have a way to differentiate itself, right? And so nobody is going to be able to look at something unless you're a expert in this and say that's a K diamond or that's a Zales diamond or whatever. So when they have done those kind of seasonal, like specialty things where they buy a bunch and they have it, but for the most part they're also just selling, about half of their sales come from wedding, and the other half is just gift type jewelry, and then a very small percentage is like watches and stuff like that.
I see. Okay. Let's move on to the next competitive advantage category, which is network effect. Is there any network effect here with Signet Jewelry?
So there's no benefit as a customer if somebody else has a K diamond, or that I also benefit from it. So I don't see any network effects here.
Okay. Switching cost.
So there's really no moat from that switch. From once you buy a diamond, they offer a little bit of service that allows you to get it cleaned, and if there's any issues with it, you can get it replaced. Within the first 6 months, as long as you meet certain criteria, you can get it replaced. If the setting fails or something like that. But for the most part, buying a K, going to another store for the next time you purchase something, there's no real benefit. So it's more of a one-time purchase, and for most people, their wedding band purchase is a one-time thing, right?
Yeah. I also imagine that it is something that a lot of other companies also offer.
Yeah.
Right. So it's not really a competitive advantage if everyone else does it.
Well, and think about it this way: half of their stuff is wedding, the other half though is gifts. And so if you're looking to buy a gift for a significant other or a family member or something like that, your gift doesn't have to just be jewelry, right? You want to spend $200, you can also buy them, clothing or furniture or some other type of gift. So their competition isn't even necessarily just jewelry, right? It's so you think about them as a jeweler, but their money may be spent in other ways. You may buy them a plane ticket and go somewhere, for a vacation, right? So the money that you spend at one place is not necessarily being allocated just for jewelry, right? People don't have a jewelry budget, or some people may do, but it's a gift budget. And so you should be really thinking about it. Where is the competition for their money is really what I would buy a significant other or anything like that, right? So any type of gift that I would purchase.
It triggers kind of two just thoughts and comments. One is understanding the market, understanding the total addressable market. A lot of people talk about total addressable market.
Yeah.
I think that's one thing that we have to be careful of and be mindful of. And the other comment just came into my head when you were talking about what their competition was. You know how Netflix, when they first came out, they said our competition is all forms of entertainment, not just movies. They said one of our competitions is sleeping.
Yep.
Like people, they can choose to watch Netflix or they can choose to sleep. It's upon customers' decision to do that, and they categorize sleeping as one of their competitive, competition. So I thought
to be fair,
that was
you can actually watch Netflix and sleep at the same time. So
that is true.
That is what happens often when I try to watch a movie. So
that is true. That is true. But like that's this sort of thinking, I think is very helpful. I think that sort of thinking is very helpful, not only in terms of understanding the business, but also in terms of the market opportunity and what kind of pile of cash are they going after.
So I think one thing I will say that a lot of people mistake when they think about investing is they fail to understand opportunity cost, right? So opportunity cost applies to everything, right? You have a certain amount of money, you can't use it twice, right? If you spend it in one place, you can't spend it in another. And that applies to what you purchase as an investment. It also applies to how a consumer thinks, right? And so they may not even know it. They may not even know the term opportunity cost, but they realize that if I'm going to go buy a Nintendo Switch, well, I don't have an extra $300 to also buy a diamond for my girlfriend, right? So I would always kind of think about that whenever you look at businesses, right? When you look at Visa, right, their competition is not really MasterCard as much as it is, they don't have competition, right? I can have both types of cards and Visa still, wins, right? So think of the opportunity cost in every kind of scenario, right? And what are the incentives for the consumer whenever they're purchasing something? And I think that'll help you really kind of crystallize the moat in your mind.
Yeah, absolutely. Okay, let's move on to the next competitive advantage category, which is low cost. Are they low cost provider in the diamond business?
So no, they do source the diamonds directly from Africa, and they have from Botswana, and they have some scale that allows them to get some discount. But for the most part, they're not the ones mining the diamonds. They don't have a supply chain benefit from doing that. So I don't see there being a significant low-cost moat here.
Okay. And then lastly, let's talk about intangible assets. Do they hold any intangible assets that could set them apart from other retailers?
So no, I don't think so. I don't really see anything here like patents or anything that would make me think this company has a benefit that I can't see on the balance sheet or anything like that. It's, this is a fairly straightforward retailer, right? They buy an item, they mark it up, they sell it, and they sell it either in a retail store or they sell it online now. That's
Okay.
kind of the story there.
So just to quickly kind of recap on that, I think we heard a lot of no's. Network effect, no. Switching cost, probably basically no. Low cost, intangible assets, all no's. And then one thing that you did touch on was brand, but it was a weak brand, competitive advantage. But nonetheless, it was the only thing that you said yes to.
Correct. I would say that they do have some brand recognition, but I don't know that recognition translates to, say, paying a higher price, right? And that's really what a moat would be, is paying a higher price or driving customers away from their competitors towards them. And I don't see that really here.
Okay. I think it's a good segue into the next question, which is, how durable is the competitive advantage? What are the risks to the current competitive advantage, if there is any?
Yeah, so I think there's a lot of risk to their competitive advantage because, as you know, 20 years ago, malls were kind of the place people went to buy stuff, right? If you were looking for anything that was clothing, apparel, fashion, jewelry, you went to the mall, right? The mall as a as kind of the haven for shopping has kind of slowly eroded as the internet has kind of taken over. And so their benefit is now they are in a sea of lots of other retailers online. You can buy diamonds and other things there, and you don't have a real, durable competitive advantage, right? I think, first of all, they don't have a moat that I would say is very strong. And two, because they don't have that, I don't know that you can even say that they have a durable competitive advantage, right? People are going to walk by, they're going to say, oh, that would make a nice gift, and they go and purchase, right? And there's some value in being omnipresent, but I don't know that there's a durability to it, right? If K went away tomorrow, I'm just going to go find another place to buy jewelry, right?
Mm-hmm.
And
yeah, one thing that I do want to touch on is, this kind of transition period for a lot of retailers trying to become more omnipresent, omni-channel, right? So from that perspective, I guess you could, make an argument for both cases. But Signet, if there were any jewelers out there, they would be well poised to make that transition more smoothly than other jewelers because of their retail presence, because of the brand, because of the the footprint that they already have. What do you think about that from that perspective?
Yeah, I mean, I think there's definitely benefit to being already present. Right. I don't know that they're going to get a lot of new competition. This is an old market. It's growing. The jewelry market grows at around 2.5% per year. So competition is not going to come from the new entrants. It's going to be coming from places where they're already an existing strong business like Amazon or Walmart or Costco, which a lot of people buy their jewelry now at Costco and places like that. That's where the moat is slowly getting eaten, right? Is people are going to Costco. I have a big discount at Costco because I pay for the membership. I love Costco because it has all this stuff. So I go and buy everything there, right? And Costco maybe gives me a better deal, but I also know that I have great customer service there. So I think it's funny because, specialty retailers became a thing because people wanted more selection, more service, more options. And now it's kind of going in the opposite direction, right? You have now specialty retailers are kind of left on an island, and people aren't going to them as much because people like the convenience of going to one place to shop for everything. Oh, if it's the same book that I can buy at Barnes and Noble, I can buy at Amazon, but Amazon gives me 2-day shipping, so I'll just buy it on Amazon, right? I think there's a lot of that going on.
Yeah. One other thing that, as we were mentioning, I just want to harp on the point that you pointed out earlier. What is eroding their competitive advantage is not only these big retailers that are getting into the space, but also, as I mentioned, maybe handing out a diamond ring or a necklace. Maybe, I don't know, I'm just speculating. Maybe coming, not it is no longer in fashion. People would rather go on exotic vacations, for example, or things of that nature. More experiential gift. It could be eroding their competitive advantage and their market presence also.
Yeah, and I think there's something to be said for that. There's cultural tastes are different than they used to be. So, people are not spending money on jewelry; they're spending money on vacations and other things that eating out more, or they don't have as much money to spend. I mean, one of the things that is occurring is also that people are getting married less, right, than they used to, and that's because of debt and student loans and all of these things that make it more difficult for people to get married, and that kind of changes it, especially if half your business is based on weddings, right? So I do think that there's something to be said for that also, is that that's not how people spend their money.
Mm-hmm. Yeah. Okay, great. Let's move on to the next question. What are the company's long-term prospects and runway for growth?
So the jewelry market is not really growing, right? It's a 2.5-3%, so it grows at around the rate of inflation. Their revenue has been pretty stable for the last 4 or 5 years. So just as a numbers game here, it's been in between 5.7 and 6.2 billion from 2015 to 2019. And there's not a whole lot of growth there. They've been actually shrinking their store count fairly, letting leases expire in places that aren't the best retail markets. I want to say that they closed about 200 stores in 2019, and they planned on closing 150, so 262 stores in 2019. Most of those were places that they already had another store in that same mall, which kind of tells you that they were, their own competition in some ways. They were planning to close 150 in 2020. And as I said, the annual report has not come out, so it's a little hard for me to say how many did they actually close. So if anything, they're shrinking. It's a question of how fast they're shrinking. Their e-commerce market is actually growing, but it's a small percentage of their revenue.
Mm-hmm. Okay. Let's move on to the next question. Does the company require a lot of capital reinvestment to maintain its business? Can it grow without any further reinvestment?
Yeah, so to give you an idea of how much they invested, in 2017, they spent $67 million on new stores and $98 million on remodeling. So for a total of $165 million. So that is basically growth and maintenance capex. In 2019, that number was 17 million for new stores and 53 million. So 67 down to 17 and 98 down to 53 for a total of 70 million. So from 166 million to 70 million. So they cut it by more than half in 3 years. So remodels, I think, are, with 2,000 stores, $50 million, it's not a whole lot per store. And their stores aren't that big. Their Jared stores are bigger, but the K and the Zales are generally relatively small kind of stores. So I just don't see, a lot of, and to give you an idea of how much that is changing, it's about negative 5% growth in their store space per year. So they opened about 40 stores in 2019 and closed 230. So it's definitely shrinking, size wise, and retail space wise.
Yeah. So just to kind of reiterate your point, the entire jewelry industry is only growing at about inflation rate, about 2%. And then on top of that, because of the transformation that they're undergoing, in addition to the industry-wide slowdown or stagnation, they are closing a lot of shops. And you are seeing that reflected in the growth in the maintenance capex, or the maintenance capital investment, and then just regular capex for further growth.
Yeah, and to give you an idea, the e-commerce was in 2019 was about 12% of sales, and it grew by about 40%. So it is, but what is unclear is it really cannibalizing their existing, right? Are people just, instead of going into the store, they're just buying there, or is it new customers? And it doesn't look like it's new customers. Mm-hmm. So
even if it is, let's say it is not new customers, even if it is existing customers, one of the things that we saw over and over again with these omni-channel online distribution is that it is a higher margin business.
Right.
So from that perspective, it is not a bad thing that e-commerce business is growing, even though it might be cannibalizing the retail business.
Yeah, so it really comes down to, if this is an expensive item, let's say you're buying $1,000 item, $5 of shipping is not really a big deal. But if you're selling a $30 item, $5 of shipping is basically your entire margin, right? So you have to kind of think about it from, jewelry is small, it doesn't weigh much, doesn't cost much to ship. Clothing and other things it has a bigger impact on them. So for them, e-commerce may have different margins than a clothing retailer, where, and you also have in retail, e-commerce has a lot of much higher return rate, right? And so that return rate really impacts your ability to get, your margins. So, whereas if you're in a brick and mortar store, it's customer's gas and the customer's time that is spent, doing that. So, just some things to think about when you're looking at these, that all retail businesses aren't the same as far as margins for e-commerce.
Mm-hmm. Great. Let's hit on this last question for this episode, which is, does the business have favorable relationships with the following? So I'm going to list out 4 right here: customers, suppliers, employees, and lastly, regulators / community. Any red flags that you see here?
Yeah, I don't want to dwell too much on this question because I think we have other stuff to cover, but I don't really see anything there that makes me say I would be worried. We will talk a lot about their finances and stuff like that, but that doesn't really have much to do with, I don't see any real problems with their customers. They did have some bad PR, around when the Me Too movement was happening and things like that. And so they kind of shifted, and this was like 3 years ago. I don't know how much people remember from that and how much it's affected their sales. I mean, their sales have been kind of flat. But I don't really see any red flags anywhere.
Okay. Sounds great. Thanks for all the research, the comments, Hari. Let's close out this episode with that. Do you have anything to add before we do that, Hari?
No, I think the only thing I would really talk about here is, we're kind of in this, in the midst of the coronavirus, things are kind of unprecedented, right? We're seeing a lot of businesses that have been cut in half in terms of valuations. And, you operate off of imprecise information, right? If I knew exactly what this company would be like in a year or two, things would be totally different, right? And so you want to remove as much of the risk as possible, right? And so at this point, nothing that I've really said tells you anything about whether or not this is a good stock, right? We've basically just understood the business. We've talked about what the business does, but risk is associated with how much you pay and how likely that this company would just go completely belly up, right? Those are the two things that we have to worry about. And I don't know about you, Becco, but I have not heard anything that makes me answer any of those questions yet, right? Would you agree with that?
Yeah, I would agree with that. And I would also add that there's nothing compelling in terms of competitive advantage that draws me further.
Right.
I would just add that on top of what you said there.
Yeah, so this is more, for me, I'm thinking about this from a cigar butt type model where, this is super cheap or potentially super cheap, and it's got to have a huge margin of safety for me to really think about investing. So, so that's kind of my preliminary conclusion halfway through this, this discussion. Just so everybody knows what they're thinking, what I'm thinking at this point.
Great. All right. Thank you guys for joining us in this episode. We will see you guys. Oh, well, before you do, again, I just want to reiterate this. If you guys want a copy of this checklist, please email us, info@valueinvestor.org. And as I mentioned earlier as well, Slack channel, please, if you would like to be part of that, email us as well at info@valueinvestor.org. All right. Thank you guys for joining us. We'll see you on the next episode.
Thanks.